Hey everyone, welcome back to our channel, and today I'm going to talk to you about the top 10 hold forever dividend stocks that was chosen by our community. We asked this question on our social media platforms, mainly Facebook and Twitter, and we asked everyone to vote on what their top holdings would be. We've counted up all the votes and we have our top 10 holdings. Now there is a wide mix here. Some are high yield, some are low yield, some have high dividend growth, and some have low dividend growth. So I think the fairest way that we can compare them is probably by using the Chowder rule. Now, for those that don't know what the Chowder rule is, European DGI has a video about this on his blog, but as a quick introduction, it is a rule that was made famous by a Seeking Alpha author. Now, it has three main rules. Basically, it looks at the dividend yield and the 5-year dividend growth rate. And if a stock has a yield more than 3%, then you're looking at a Chowder rule of around 12%. If a stock has a yield that is less than 3%, then you want more dividend growth. Then you're looking at a Chowder rate of around 15. And for those slow growing companies such as real estate investment trusts or even utilities, you probably want a Chowder rule that is greater than 8. Now that we got that out of the way, let's jump right in and see what our community picked as their top 10 hold forever dividend growth stocks. So the company that came out on top was none other than Visa, ticker symbol V. Now, honestly, guys, this was super close. There was only 2 votes. Yes, 2 votes between the top 2 positions. But ultimately, Visa came out on top. And honestly, it's not hard to understand why. We know they have a huge moat. Their real competitors are American Express to a certain extent and MasterCard. But the volume that Visa have is phenomenal. I mean, I don't know a single person that doesn't use Visa. And let's look at some of these numbers. I mean, look at the revenue growth over the last 3, 5, and 10 years. It's been super consistent. Near enough double digits every single time. And the same with earnings. Earnings per share over the last 5 years has grown at 12.6%. And over the last 3 years, it has grown at 18%. I mean, all their metrics just blow it right out of the park. You can look at all the return metrics, such as return on assets, return on equity, return on invested capital, and we're talking about double digits every single time. And even look at their debt to equity. We're looking at 0.5 with an interest coverage of 38.5. So, I mean, everything just knocks it out of the park for these. The dividend yield is super low, though. It's 0.7%. And with a 5-year dividend growth rate of 15.1, that gives them a Chowder rule of 15.8, which would make this a good candidate. However, for me personally, the yield is still a little bit too low, but let's have a look at that dividend chart. I mean, we talk about chart porn on Dividend Talk quite often, and look at that. It's almost a perfect dividend chart. It looks absolutely incredible, and it is what every single dividend investor wants to see. So, who came in second place just behind Visa? Well, it's none other than Microsoft. And honestly, European DGI is probably delighted with this one. It's no surprise that this is one of his favorite companies. Actually, that's also his favorite CEO, but Microsoft are a really strong company. We speak about them nearly quarterly on our podcast. We always do their earnings, and their growth has been quite phenomenal, particularly since the cloud business got involved. And I have to say, personally, I have no shares in Microsoft. I had them at one time. I tried to time the market, and I've learned a huge lesson in learning to let your winners run. But I'm happy for the likes of European DGI, who has bought these at a solid price and managed to hold on to them, improving both their yield on cost, but also their capital appreciation. But again, let's look at these figures. Quite similar to Visa, I would say, when you look at their growth rates. You can see that it's double-digit revenue growth over the 3, 5, and 10-year period. Earnings per share kind of follows that as well. You can see that we've got 18% over 10 years, 16% over 5 years, and nearly 10% over 3 years. Again, their debt is really low. They've got a 0.3 debt to equity ratio with an interest coverage of 43.2. The only problem I have with these at the moment is probably similar to Visa, and I didn't speak about that before, but look at their valuation. You can see their PE ratios are trading in the high 20s, nearly early 30s, which is probably a little bit rich for me, but I can't complain. I had the opportunity to buy them way back before COVID, and I bought them and sold them at 180, thinking they'd drop back down to 120. So I'll never make that mistake again. But look at their dividend yield. It is 0.8%, which again is on the low side. If you couple that with the 5-year dividend growth rate of 10.2, they just fall short of the Chowder rule. But again, let's look at their dividend chart. And probably not as impressive as Visa's, I have to say. It doesn't quite go up as vertical, but again, it looks quite impressive, and a chart that if I owned this company, I would be quite happy to look at every single year. Just look at that rising. Number 3 on the list is probably going to be your more typical dividend growth stock, and that is none other than Johnson & Johnson. We speak about them on the podcast. We say that their earnings are like clockwork. They generally increase the dividend around 5%. So it's no surprise to hear that people have voted them to be the number 3 company. I'm personally not as bullish on these as European DGI is. And the reason being is that they are now a pure play medtech company, and the pipeline needs to be a little bit more understood. But it's hard to argue against the management. They've done really, really well over the last few years. And again, look at their growth rates. Revenue has been kind of flat. It's been like 1 and 2%, so not as high as what we've seen with the last 2 companies. Earnings per share have followed that kind of road as well. We can see that earnings over the last 10 years is flat and even negative over the last 3 years. And again, that's massively down to selling their consumer staples part of the business. Their dividend yield stands at 3.2%. So what we need here from a Chowder perspective is around 12%. But we look at that dividend growth and we see it's only at 5.5%. So we get a Chowder rule of 8.7, which is far below what we would expect in terms of dividend growth for a company with this type of yield. But again, their debt to equity is 0.5. The interest coverage is quite well, so they can service their debts quite easily. But honestly, when you look at this, it actually doesn't look as impressive as the last 2 companies. But you do get a better dividend yield starting. And for myself, 3.2% yield and maybe a 5.5% dividend growth rate just about scrapes into my portfolio. So number 4 on the list is the world's most famous real estate investment trust, and that is Realty Income. And they are known as the monthly dividend paying company. I mean, everybody knows this company. Everybody loves monthly dividends. So it's no surprise to see this company on the list. And we look at their growth over the last 20, 30 years. You can see since 1994 that their historical dividend yield has been around 6%. They've got an adjusted funds from operation growth of around 5%. And their average return is around 11%. And we know that with real estate investment trust that it's all about the funds from operation growth, or should I say the adjusted funds from operation growth, as this is where the dividends is paid from. You can see this nice little chart on the screen here that they have been growing that quite consistently, I would say, since 1996. It had an average growth rate of around 5.2% between 1996 and 2008. And it has an average of 5.4% since 2009 up as far as 2022, which was on the last investor relations that I found. But again, everybody knows this company. It is grown so big that they are now diversifying into gaming. They are diversifying into data centers. They are even diversifying into Europe. So it's quite exciting. And maybe I might do a little bit more of a deep dive on these in one of the next videos. In terms of the Chowder rule, it is currently sitting at around 8.4%, which for a real estate investment trust is above the 8% that is required by that rule. So it does look good from that perspective. But we only invest in this company for its dividend, and look at that chart. I mean, they have increased their dividend for 109 consecutive quarters. That is crazy. And it's probably one of the reasons why everyone loves this company. You're getting a monthly dividend and it's increasing quarter on quarter. Their compound average growth rate is approximately 4.2%. They have a yield now of around 5.5%, I think. And they've paid dividends for 55 years. So, of course, I'm not surprised to see this company come in and around one of the top 5. Now, the fifth company on the list actually surprised me a little bit, and this is Coca-Cola. And actually, I didn't realize they had so many brands, even though most of them are some variations of their famous Coke. But Coca-Cola was made famous from the dividend growth perspective because of Warren Buffett. But let's have a look at some of their numbers. And you can see again the revenue growth was quite slow over the last 10 years, but you can see it's starting to ramp up over the last 5 and 3 years. And they went through some restructuring processes as well, which we discussed in our podcast at one point. Earnings per share has been quite consistent. It's grown between 3 and 4%, which means that their dividend also grows around 3 to 4%. The current dividend yield is less than 3, so it is 2.8%. And we know that if it's less than 3, that the Chowder rule should be 15, and they are nowhere near that level. I mean, they've got a relatively low starting yield and low growth, so you're not buying this for lots and lots of growth. It's more of a slow compounder that's a steady staple in your portfolio. And look, sometimes slow and steady wins the race. But maybe let's have a look at the dividend chart before we move on. And again, that one looks quite impressive. It has quite a steep incline and it just keeps growing and growing and growing. So these are the type of dividend charts I like to look at. We've gone through 5 companies now, and I have to say I was a little bit disappointed in the top 5. They are all pretty good companies, I must admit. But remember, our audience is predominantly European. We're Europeans, and I have not yet seen a European company in the top 5. Well, luckily for us, that changed when we look at the 6th company, and that is none other than L'Oreal. And we probably could have guessed that this was going to get in there somewhere. L'Oreal is one of the most famous beauty brands in the whole wide world. And to be honest, we know European DJI is a huge fan. He did a deep dive on these in our newsletter, and I have to say, it's not hard to understand why they're one of the best companies in the world. And again, let's look at some of their metrics. We can see that their revenue growth has been quite consistent over the last 10 years. We're looking at around 6 to 10%. Earnings has been growing quite well actually over the last 3 to 5 years, particularly since COVID. Dividend growth has kind of followed that lead. We can see the 10-year dividend growth rate is 10% and the 3-year is 13.4%. So when we couple that with its dividend yield of 2, we get around a 14.7 Chowder. And I have to say that is very, very close to the 15. So we'll give them a pass from the Chowder perspective. So finally, like we've done with all the rest, let's take a look at that dividend chart. And we can see it is not as impressive as the rest of them. But you can see over the last 3 years, there's been massive, massive growth. It kind of tapered off between 2019 and 21. COVID had a big impact there. But since then, growth has accelerated and they have rewarded those shareholders with big, big increases. I'm glad to see that we're sticking with the European trend, and in at number 7 is Shell PLC. But honestly, I was quite surprised to see this company in this list, and that is because the title that we sent out, or the request that we sent out, was to pick the top 10 forever dividend growth stocks. Now, when we look at Shell, they have been no strangers to some setbacks and turbulence, particularly in 2016, 2018. They even cut their dividend back in 2020. Now, it's well reported on our podcast that we did not sell them at the time. We felt like it was good for the company. We felt that there was definitely more growth in the future, particularly after the acquisition of British Gas. And since then, luckily for me and luckily for European DJI, that has turned out to be true. And in that time, they are honestly being share cannibals. They are buying back shares like there's no tomorrow. They are raising dividends quite aggressively. Their debt is now manageable, even though we would like to see them probably get that under a little bit more control, like ExxonMobil or Chevron. But I am a fanboy, I have to say. Even though I personally wouldn't put them in a list like this, I still think they're a good company and they have a place in your portfolio. But if you look at these metrics, if you look at the revenue, look at the dividend growth, and even look at the earnings per share and compare that to companies that we've had before, particularly the Microsofts, the Johnson Johnsons, the Visas, this is not at the same level. But who am I to argue with the community? The community voted this in at number 7, so it deserves a place in that portfolio. We're getting close to the end, but number 8 is another real estate investment trust, and this time it is Agree Realty, ticker symbol ADC. Now, this is one of my favorite REITs, and honestly, when this is trading in the low 50s, I was loading up on them, so much so that they are now a top 3 position for me. I Spoke about them a couple of videos ago, so I won't speak too much more about them. But let's look at their dividend growth. So their yield currently sits at 4.3% and their 5-year dividend growth is 5.6. So you can see their Chowder rule is at 9.9, which is even better than what we saw at Realty Income, and it fits perfectly under the Chowder rule for real estate investment trusts, which is 8. However, like Shell, I am a little bit surprised that this company made the list. And the reason for this is that it has cut its dividend before. We don't have to go too far back to see that. You can see it right there on the chart. They cut it back in 2011. The only thing that gives me a little bit of comfort is that the CEO was recently on Dapper Dividends and he said that the dividend is sacrosanct. So he's not going to cut this for no reason. You can see that adjusted funds from operation is growing with the company. And if that continues to grow, then the dividend will grow with it. So for now, I'm happy to hold the company and it sits at number 8 in our list. The second last company that made it onto the list is Louis Vuitton Moet Hennessy, ticker symbol LVMH. And again, this is another French luxury company and another company that European DGI knows very well. He's actually become the master of French luxury, in my opinion. But I mean, let's look at some of the brands that they have, and they have an absolute empire. There's probably not many names on this list you would not have heard of before, but they've got everything from watches to private equity to wines to perfumes to clothing brands. They've got literally everything. It's all down to that one man, Bernard Arnault. I mean, what he has done is pure genius. But again, let's take a look at some of the top and bottom line numbers. The revenue growth has been quite strong. It's been averaging around 10% over the last 10 years. The earnings growth has been around 12%, even though over the last 3 years it's 1.7, but generally it's around 8 to 12%. And their dividend growth has been quite strong as well. You're looking at 15% over 10 years, 22% over the last 5 years, and even 9% over the last 3 years. With a dividend yield of 1.8 and a 5-year growth rate of 22.1%, that blows the Chowder rule out of the water. But honestly, I would not be expecting 22% over the next 5 years. I think closer to 9% is more practical for LVMH. But let's look at this dividend chart. Now, what you will notice, again, this is the third company in a row on this list that has cut its dividend. And they cut it in 2019 as they were under serious pressure from the French government at the time, and also earnings were struggling. But you can see they have recovered quite strongly, and as revenue and earnings and free cash flow recovered, they rewarded shareholders with. And last but not least, the last company on our list is British American Tobacco, and they are here to help us make a better tomorrow, which I always find quite funny. But look, again, it's a company that I spoke about quite recently in our top 5 UK dividend growth stocks. They want to be a predominantly smokeless business by 2035. I don't know how feasible that is, given that new categories is not growing as fast as I would expect. I think they were expecting around 5 billion in 2025. That is definitely not going to happen, as it was down around 3.5 billion this year. However, they do have a really, really high dividend yield. I'm not expecting a lot of top line growth, particularly with combustibles declining and relying on this new categories to try and bump them up. So that's kind of flat over the last few years. Earnings per share has been struggling as well. But as I spoke of before, their free cash flow generation is quite strong. Their debt to equity is reasonable. It's 0.7, even though their interest coverage is lower than what I would like. Their dividend yield, as I mentioned, is 7.8, and with a 5-year dividend growth rate of 3.4, they just about miss under a company that would fit into the Chowder criteria. I have to be honest, again, I do like this company, but I don't think it fits into a portfolio where you are buying and holding forever. It's not a forever dividend company for me, but I can't argue with the community. It was picked at number 10, slightly, I must say, ahead of Siemens. So there you have it. That is what our community picked as their top 10 forever dividend growth stocks. I have to be honest and say that I do not agree with all of them. I probably would not have put someone like Coca-Cola, British American Tobacco, and even Shell into that mix. If I had to replace one right now, I would take out Coca-Cola, I would say, and replace it with a company like ASML, or actually, do you know what? I would probably put in Spirax Sarco. I do love engineering companies. It's my circle of competence, so I would definitely put a company like that in the mix. But I'm curious to hear from you. What companies would you remove from the list, and what would you put into the list? Please let me know in the comments below. And if you like these type of videos, I would really appreciate it if you hit the like button and even subscribe if you get the chance. See you next time.